10-year note Treasury yields end the session lower in about a 17 basis point range, trading all the way down as low as 289 and as high as 306, but ended the session near those lows at around 290. Coming after a stronger than expected CPI, which printed 9.1% year over year. Likewise, anticipation of how the Fed will react to this higher inflation. We saw Fed funds pricing in near 70% odds of a 100 basis point rate hike in 2 weeks at the July FOMC meeting. Prior to this, they were talking about 50 or maybe 75 basis points. And ultimately now the market leaning more towards 100. So a big shift there after today's CPI. Now 10-year note yields, which have been hovering around 3%, saw a bit of a move higher last week after we received the FOMC minutes from June, when the Fed declared that they were going to fight inflation, despite the fact that growth numbers are struggling. They were going to use inflation first and then worry about the growth. So ultimately, 10-year note Treasury yields, which had dipped well below 3%, rally back above 3%, and now again we're back below. So a lot of choppy trading, we'll call it, in 10-year notes. Likewise, the 2s-10s Treasury curve, which is a good indication of the market and the economy, when it has flipped inverted earlier this week, got even more inverted today to its lowest since October of 2000. So you got to go back over 20 years last time we saw 2s-10s inverted this much at negative 24. Now, what does this all mean for volatility? Well, check out that CVOL index over at cmegroup.com. You'll notice that volatility did see a nod bid ahead of the CPI number today. However, we always say that, after the event, volatility came off. Similar to what we saw after the minutes last week, we saw the same type of move today. After the CPI came out, we saw volatility move lower, down to session lows. It did recover slightly off those session lows, but ended lower on the day nonetheless. Clearly, the market pricing in a lot of different scenarios here, so it will be interesting to see how the market reacts over the next several sessions leading up to that July FOMC in 2 weeks. Lastly, let's talk about what we have tomorrow and later this week. Well, tomorrow we get the PPI number, which is also expected to be higher, going along with CPI today. Likewise, we get the claims number, which is our in-the-moment look at the job market. That is also anticipated to be higher. Claims have been sticky high over the last several weeks. It'll be interesting to see if that comes down a little bit. The job market has not been a focal issue here because jobs have not been the problem. However, with inflation running higher, the Fed doesn't want to see those jobless claim filings continue to increase. Lastly, we're going to get some Fed speakers. We get Fed Governor Waller speaking. Today we heard from a couple Fed speakers trying to talk down the 100 basis point rate hike potential at the next FOMC meeting in July. But ultimately, the Fed will continue to talk about fighting inflation at the expense of growth, at least in the short term. It'll be interesting to see how the market reacts, because right now the market is leaning towards a 100 basis point rate hike at the July FOMC. So 10-year note yield still hovering around 3% today, opening up higher and then moving lower down to 290 in the face of higher inflation, in the face of higher uncertainty, and ahead of a Fed meeting, which will be very important in 2 weeks from today.